Welcome to another video. Today we're going to do a South African finance crash course. We're going to cover employee versus business owner, the tax benefits, how business owners can structure, and how money flows in a company. So the main difference between an employee and an employer or a business owner is that an employee receives their money after tax has already been handled. They then use this money to pay their expenses, laptops, cell phones, Wi-Fi, rent, etc. A business owner, on the other hand, makes money, pays expenses that they can write off against the business, and then pays the tax. That means a business owner arguably lives cheaper than you. So how a business works is it makes money, it pays all of its expenses, and then it pays tax. Now, the current tax rate in South Africa on profits is 27%. Once this 27% on the profits has been paid, you're left with something called retained earnings or profit after tax. These retained earnings or profit after tax can be then declared to the shareholders of the business as a dividend. Thus, if you're a shareholder of a business, you can take out the retained earnings or profit after tax in a company if the solvency and liquidity tests are met. However, you'll be charged an additional 20% dividends tax. So that's generally how finances of a business works. Of course, this is only high level and you must always consult a professional. So now, what a lot of business owners do is instead of paying that extra 20% on money they've already paid the tax on, is they start investing in different assets at the operational company level. This can include property, investment portfolios, and the list goes on and on. Why do they do this? Well, because it's cheaper money. However, the problem with this approach and just reinvesting everything into the business that is not necessarily related to the operating company is that it's risky. If something goes wrong with this business, then all of the personal assets, property, and investments come under repute. This is where business owners often consider structuring. When we talk about structure in a business, it can take place in many different forms. I know there's sales pipeline structures, there's employment structures, but what I'm talking about is a corporate structure. A corporate structure comprises of one or two things, either a holding company or a trust that owns a holding company. I'm going to talk about the latter, the trust-owned holding company, in this video. Now, a trust can be a very great vehicle because no one can own a trust. You can only represent a trust as a trustee. Now, because nobody can own it, you see then how assets housed within the structure are protected because you don't own them. So if a business owner gets sued, and their business is held 100% in the correct trust-owned company structure, and the lawsuit is involved with the person and not necessarily with the business, then you see now how the business is protected because the business owner doesn't own it. That's asset protection. The next is estate planning. Now, we all want to build wealth for the next generation, and especially when your business starts to scale, you start thinking long-term and about succession. Who's going to take over the business when you die? Are the kids going to take it over? Are you going to hand over to your star employee? Or are you going to liquidate altogether? If you want to choose the first two options, i.e. succession planning, a structure then becomes even more beneficial. Because you don't own the business, because it's in the trust-owned company structure, when you pass away, it doesn't form part of your estate. And we know that when a person dies, there are various death taxes. For example, the first 3.5 million is tax-free. Then from 3.5 million all the way up to 30 million, you're taxed at 20%. And then any of your net asset value above 30 million, you're taxed at 25%. And then there's something called capital gains tax. Now, capital gains tax is the tax on the growth of an asset over time. For example, you start a business at 1 Rand, that's the base cost. If you then sell it in 10 years for 10 million, that growth may be taxed at the capital gains tax rate of 18%. Now, importantly, when you pass away, it's a deemed disposal for tax purposes. That means that 18% may be triggered. Notwithstanding all of these taxes, there's also executor's fees, which is the fee that an executor charges to wind up your estate, and that fee is 3.5%. So you can see now how succession planning and having your company in the right structure can be beneficial from not only an asset protection standpoint, but a succession planning one too. Once your company is in the correct structure, there's also a lot of reinvestment or capitalization benefits. In our earlier comments, we had a business that didn't want to pay the dividends withholding tax, so they reinvested everything inside the company, property, stock portfolios, etc. And then if something goes wrong with the business, all of that comes under repute. However, if structured correctly and you're in this holding structure, you could take out those after-tax profits from the trading company to the holding company at potentially zero dividends tax. That then allows you to reinvest into your properties or investment portfolios at holding company level, which is of course separate from operational risk. So then if something goes wrong with the business, the investments out of the holding company may be safer. Notwithstanding this, but once the money's at holding company level, the board of directors can decide to capitalize other structures, i.e. invest in new businesses, or even new trust-owned company structures, where that new investment can be even more bulletproof. So structure's not only about tax, but it's about asset protection and succession planning. Remember, these structures require a lot of thought and a lot of admin and paperwork that must line up in order for it to be effective. So for that reason, you must always consult a professional. A quick recap. A company makes its revenue or income, it then pays its expenses, staff, salaries, Wi-Fi, maintenance, rent, etc. It's then left with what's called profit. That profit is subject to the company tax rate of 27%. Once that tax has been paid, you're left with something called profit after tax or retained earnings. If the business owner holds shares in their personal name, that profit after tax or retained earnings, if the solvency and liquidity tests are satisfied, can be extracted from the trading company as a dividend to the shareholder. That dividend will attract 20% dividends withholding tax at the company level. However, if the business owner is structured correctly, that same profit after tax or dividend may be declared to the holding company at potentially zero dividends tax. That allows the business owner to reinvest in an entity that's separate from the operations. Moreover, instead of only investing at the holding company level, they could use the money to capitalize future acquisitions or capitalize other structures where that money can be invested in different ventures. A whole structure is all about asset protection, estate planning, and tax efficiencies. But the mechanics must fit together, and for that reason, you must always consult a professional.